Hey there, real estate pros. Welcome to your midweek mortgage update. Get the latest rates and insights to boost your business. Stay ahead in the game with expert tips. Ready to make smarter moves in real estate? Let's dive into today's mortgage trends.
Hello, realtors, and welcome to your midweek mortgage update. I'm Joel Wills, mortgage broker, and as you can see, there's some great news on ARM rates. They're coming down and are a great option for your clients to get that monthly payment lower and make a deal work. Rates overall are holding steady this week, but keep in mind that the market is very volatile and volatility can change things rapidly. So if your client likes a rate, let's lock them in. Today's featured rate is an FHA 5/1 ARM at 5.75% with no points. That's with at least a 640 middle FICO score. For a quick example of how much that can save your FHA clients, let's consider a $600,000 base loan amount. And if you take a look at the sheet, that 30-year fix is 6.375%. That gives us a principal and interest payment of $3,808.73. That 575 ARM, that payment drops to $3,562.72. It saves $246.01 per month. That could be enough to make the difference in someone choosing to purchase or not. Keep in mind, a lot of these clients want to have total principal, interest, insurance below a certain amount, and this loan can make that happen. Like say they have a cap at $4,000 on a 30-year fix is $4,100, $4,200. We can bring it below that and make it work. A lot of my agent partners say, "Hey, Joel, customers are going to object to ARMs for various reasons, but the biggest and most common misconception I hear for this objection is that ARMs caused the housing crisis of 2008. And that's not true. It was a lack of credible underwriting standards and an oversupply of homes that caused that. We don't have either of these things going on today. So let's keep this option on the table because it can make the difference in a deal working out or not working out. If you run into this objection about ARMs causing the 2008 housing crash, there are two important factors that can really help open this as an option and overcome that objection. All right. The first is, let's take a look at what these rates were doing historically during the run-up and collapse of the housing market. As you can see, 2005, 6, 7, 8 rates were going up. Market crashed. They actually came down. So for folks who were coming out of their adjustable period, rates actually went down and payments actually went down. So it really wasn't a causality of what that was. It was really bad underwriting standards. Second, and this one's great news, Fannie Mae is forecasting that conventional rates, keep in mind that conventional rates are typically at least 0.6% higher than FHA rates. But conventional rates are forecast to be in the low sixes, around 6.125% at the end of this year and into the fives in 2026. Now, if that's the case, FHA rates are going to follow, but be at least at 0.6% lower. So at 6.375% fixed today, that's going to be 5.75% at the end of the year. If these predictions work out, clients could just streamline out of their ARM right into a fixed loan. And by the way, if Fannie Mae's forecasts are correct, then we can be looking at FHA rates in the fours in 2026. It's a great way to lock in lower payments today, make that transaction work, and then refinance into fixed rate when they do come down. If you have any questions or need further details, feel free to contact me anytime. I'm Joel Wills, mortgage broker, and I'm here for you.